SEC attorney predicts an even bigger crypto crash is coming. Now, I've made a couple of videos talking about FTX and what the ramifications on the market will be, including that I'm saying there may not be, most likely will not be, another crypto bull market coming, of which I've got thousands of comments on YouTube and Twitter. I don't know what I'm talking about. So I went and got an SEC attorney who specializes in this. Not only does he specialize in it, he's represented dozens and dozens of these digital token projects. And so let's hear directly from him. We're going to sit down with James Murphy and we're going to talk about FTX and Sam Bankman-Fried. Did he break any laws, or is this all gray area? We're going to break that down step by step. We're going to talk about what Gary Gensler and the SEC is most likely to do next, what's going to happen with the Ripple XRP case. A lot of you guys are going to be interested in that. And then we're going to talk about what's going to happen maybe with exchanges and what's going to happen with cryptocurrency as a whole throughout 2023. You do not want to miss this episode. Let's go ahead and just jump right in. James, so welcome to the show.
Hey, Mark. I love your show. Thank you so much for having me on. I'm looking forward to the conversation.
Now, I know you just wrote an article for CoinDesk, and you were talking about things that you think Andrew Sorkin should be asking SBF, Sam Bankman-Fried. So for the audience that's not caught up, how could you have missed it by now? FTX, the second largest cryptocurrency exchange, blew up. It looks like clear-cut fraud to me. I know that the security laws are in a little bit of gray area, but fraud has always been fraud. That doesn't change that, in my opinion. And instead of Sam Bankman-Fried defrauding and now even admitting to in messaging in the last week or two that he's done these things that I think are fraud, he's still walking around as a free man. And even worse than that, he's going to go speak at an event, I think set up by New York Times, sharing the stage with other criminals like Janet Yellen, the Secretary of the Treasury, Ben Affleck, Zuckerberg, Larry Fink from BlackRock, etc. So he's going to be interviewed by Andrew Sorkin, probably going to be giving up a bunch of softball lobs that he can just knock out of the park, or he can spread some misinformation on. And James, I know you had written this article, said, here's what he should be asking. So walk us through some of that to start out with.
Yeah, well, great lead up. I am interested in the world of digital assets and have been paying a lot of attention to, what looks like a number of dominoes that have fallen and will fall yet. And there will be, of course, this impact on the overall market. And we can talk about that at great length. It's not just prices and viability of companies, but when you have a spectacular collapse, it creates tremendous latitude for policymakers and regulators to go after everybody else. And so I think I buy a significant part of your thesis about what is to come. But in any event, with respect to SBF, I am pretty plugged into the FTX bankruptcy and what's going on there. And, he has tweeted a little bit in ways that are nonsensical. And I thought, wow, if he's really going to answer questions of a legitimate reporter, wouldn't it be nice if some real tough questions were asked?
Right.
And so I started tweeting them out. I said, hey, look, I've been doing this for 30 years. I've questioned con men many times, dozens of times, and other kinds of fraudsters. Here's how I would go about it. And so I started putting out some of these questions on Twitter. And then all of a sudden, last night, an editor at CoinDesk called me and said, we like what you're doing. Can you put this into a format that we can run it on CoinDesk? And I said, yeah, I would do that under one condition. And my condition is I want that out there in public before this interview of SBF happens.
Yeah.
So right now it's supposed to happen at 5 o'clock. So just in an hour or so, 5 o'clock Eastern time. And so it's out there. People are talking about it. And so if I did want to make it harder for Andrew Ross Sorkin to throw softballs, there's now quite a little tiny army You have a huge following. I've got a microscopic following because I just started Twitter 2 months ago, but they're pretty worked up. They do not want softballs thrown because many of them have lost their life savings. And so
Their life
questions
savings,
are like, hey, Sam, you understand that the terms of service for your platform, FTX, say very clearly the assets that customers deposit on FTX are the property of the customer and not the property of FTX. It's in black and white, a simple statement in their terms of service. You took that money that didn't belong to you and shifted it over to your hedge fund, Alameda. You understand, I'm sure, that action is illegal, right? So, this is why I am certain that any lawyer he has strongly advised him not to answer any of these questions. But I've seen this before, and you've seen it before. These con men who are really, really smooth, slippery, whatever, believe that they can convince a whole audience of a totally different narrative that is not rooted in the facts. And so I'm afraid he may try that.
They want to win in the court of public opinion, not in law, but in public opinion. So let's talk about some of this. So I know you're a securities attorney, but to the point that you made, you've interviewed lots of people, con men and mobsters, et cetera. So let's talk about some of these things, because some people, I can't believe it. Known people in the space are saying, well, this happened in this gray area, that these aren't really securities, so maybe it wasn't really illegal. But to your point, I believe fraud is always fraud. And so if you said in the terms that these are your deposits, but then I take those and use them for my own use, misappropriating them to the words you used, regardless of what type of asset that is, isn't that still considered fraud, which is still considered illegal?
Yes.
Okay.
And you rarely get unequivocal answers from any lawyer. But the answer to your question is yes. If you are a valet at a fancy restaurant and somebody hands you the keys to their car, it doesn't become the valet's car to do whatever they want with it. But if the valet takes that car and goes and crashes it, he doesn't hand the keys back and say, hey, sorry, stuff happens. No, that's a crime. What just happened there? That's a criminal offense.
Now, I know when you give your money to the bank, though, that money is not yours anymore. They owe you that money, and there's a legal difference. And I thought that it might be the same with these crypto exchanges, where once you give it to them, they owe it to you, and it's not actually your property anymore. But you're saying that's not the case in FTX.
Now you're getting somewhere, Mark. What you just described is the situation at Celsius, and their terms of service are very, very clear that it is like the bank paradigm. You give us the money, then you are our creditor. We owe you that money, but we take dominion over that money and lend it out to other people, just like a fractional reserve model of a bank. FTX was different. Coinbase is different in saying, no, that's not our money. That's your money. And you are the one who has complete control and all ownership rights over that money when you deposit it here. We cannot borrow it from you and lend it or spend it to, in some other way.
You were saying how Celsius and some of these other exchanges are like a bank model where the money that's there is actually theirs and they owe it to you. But with FTX, they said that it was actually customer funds, and that changes things on what they're able to do, I'm guessing.
Yeah, very much so.
Yeah.
Very much so. They cannot use the money to invest in something else. They cannot use your assets and lend them to traders who want to short assets. They explicitly cannot do that. And they, of course, can't just take the assets and give it to a different company to see if they can invest it profitably and then put it back later.
Right.
That's how many Ponzi schemes evolve. very often a Ponzi scheme does not begin as a Ponzi scheme.
Right.
The person who is at the heart of it believes they can earn a return on the money that they are receiving from investors. And when that proves to not be the case, or not be reliably be the case, that's when they start, taking new money to pay off old investors, and they find themselves in an impossible spot of a Ponzi scheme. So the rules were really clear. FTX made the rules. There's no way to get around it. It is a very solid case of mail fraud and wire fraud under U.S. statutes.
Yeah. Now, what about? I'm guessing this is pretty big encompassing, but we found out that there was customers had about $1.4 billion worth of Bitcoin that they had bought and that were on the exchange, but then FTX actually had no Bitcoin at all. So they sold $1.4 billion worth of Bitcoin to customers, but actually didn't have it on their behalf. I mean, that's another big piece of fraud, I would imagine.
Yes,
right?
that is fraud. Yes.
So whether this is a flower like a tulip, or it's a share of stock like Apple, or it's a cryptocurrency, it doesn't really matter what it is. It's still fraud, and that's still illegal, right?
That's right. People do really fixate on, does this, fill in the blank, the FTT token qualify as a security? It's interesting. If the answer is yes, that means that the SEC could get involved to the extent that there are U.S. citizens who are victims of the FTT fraud, but they don't have to be. The U.S. prosecutors, it doesn't have to be a security. It's money. It's mail fraud, wire fraud all day long.
Yeah. Now, several of the questions that you had that you you hoped, you just thought maybe they should ask him these questions, but some of these would be missing money. So $515 million that was suspiciously transferred from wallets, these loans that were issued to himself and other people, things like that. And so several of these questions basically hone in on that, like, where is the money? Obviously, we know lots of money is missing. Is there any reason why you would ask him specifically, like, hey, this money, it was misappropriated, like, where is it?
Yes, there is, Mark. And this is part of my training, trying cases for 30 years. On cross-examination, quite often, you really don't care what the answer is. The entire point is the question itself. So that's why I was tweeting out these questions, so people would be aware. Sam Bankman-Fried personally borrowed $1 billion from Alameda, which is now bankrupt. Sam, therefore, owes Alameda $1 billion, which could pay off a lot of creditors. Sam's company, Paperbird, borrowed $2.3 billion from Alameda. So we've got a total of $3.3 billion that this guy borrowed. He needs to put it back. We need to know where that is, because if you think about the entire context of the scope of the problem, $3.3 billion would solve a significant chunk of the entire problem. But who knows? You and I have no idea if he's lost the money gambling, or it's on some ledger or Trezor wallet hidden underground in a bunker somewhere. We don't know. The point of the questions was simply to communicate to the world these issues and what his answers are, unless he surprises us and says, hey, James, thanks for asking. I can have that $3.3 billion back over to John J. Ray, the new CEO, in 48 hours. He's not going to say that. The point is the questions themselves.
So then the next question, which would be asking about which news organizations has he given money to, probably the answer, again, isn't that important as the question, which you're just showing to the people, like, look, he bought off a lot of these people. Would that be a fair assumption on that question as well?
Yeah, well, it's documented. I've seen documentation. I'm not going to name them because I'm not sure of, like 3 or 4, but it's just the tip of the iceberg. So he can't say none. but he probably has done it so many times, he doesn't even remember how many news outlets that are supposed to be objectively reporting on FTX and the boy wonder Sam may have been somewhat compromised.
Mm-hmm. Yeah, definitely. And then, of course, all the ties with the political situation that we have, millions of dollars of there. I know you kind of had maybe some questions about that. He came out now and said that he actually gave money to Republicans as well, but he didn't want to say that because it would be looked at very bad. He only wanted to claim that he gave money to Democrats. However, lots of people have done diligence through Open Finance and seen that there was no money claimed. Is that an even bigger can of worms now to go open up?
This is a can of worms. I get a lot of questions from people about this. It makes customers who may be out all of their money or a substantial portion of it, makes them pretty mad that where did this money come from? Are those my assets? And the thing about Democrat versus Republican, just to get some clarity on that, he gave to Democrats with a couple of exceptions. And those exceptions were Republicans who were willing to co-sponsor his bill in Congress. And one of them was the senator from Arkansas. But it was, 98% Democrats.
Yep.
His partner, however, now I'm forgetting his name. It's something like Salome, who was the quote unquote president of the FTX, was a Republican. He gave substantially less than Sam, but he did give principally to Republicans. And so if you look at the overall organization, it's some bipartisan giving there. But to me, the most brilliant move he made was when he gave an interview and said, you know what, I'm really thinking I just might spend $1 billion to get the Democratic candidate elected in 2024. Think about that.
And why is that even the more interesting piece?
Well, so they certainly were grateful, to receive $5,000, $20,000, whatever, individual Congress people or their PACs, whatever. But to say, I will spend $1 billion, this is unheard of. Basically, what he is saying is I single-handedly can push a candidate over the finish line. That is what $1 billion could do. So think about it. This gives him a 2-year runway. How do you think Democrats will treat any human being who says, you know what, I may just give you all $1 billion to spend as you see fit to elect your nominee? He had meetings at the White House. He was meeting privately with Congress people, meeting privately with Gary Gensler. He did well. He got a good return on investment of his money in the 22 cycle. But to say you'll spend $1 billion was really a stroke of genius because nobody would say anything against him, nobody on the Democratic side, for at least 2 years if he was still able and not now kind of run out.
Yeah, he doesn't have the money now. I don't know how much favors he's going to get anymore. Now, let's jump to another piece. So I put out a video on YouTube and then put out a Twitter thread on it. And basically, I was making the case that there would not be another crypto bull run. And what I was talking about was, if you look at 2017 and then you look at 2020, 2021, basically the entire cryptocurrency market cap went up. You could, basically close your eyes and throw a dart, and everything just went up at this crazy amount. And I was saying that that you have to understand how the cryptocurrency market worked in order to understand why it may not happen again. And so a lot of people just looked at the headline. They didn't like that. But the part that I was talking about, James, was that most people don't know, but most of the cryptocurrency market was driven by venture capital money because they could get these tokens at extreme discounts and then instantly have liquidity and flip them onto the market, onto retail at 5, 10x, 20x, whatever. They loved it. And then they spent all this money to then drive hype, including hundreds of millions of dollars in advertising on Google and mainstream media, et cetera. obviously Super Bowl, whatnot. And so they loved it. All the hype was built. People thought everyone was getting rich, but really it was just VCs driving this. Now, my assumption was that based off of this, and you kind of started talking about this in the beginning, these big events that cause a lot of harm then allow governments to kind of run and maybe push policy. And if they push securities regulations on these tokens, then VCs can't keep doing what they've been doing, which would then dry up a lot of that capital. I'm not saying the technology goes away or that progress happens, but we maybe don't see these big bumps. So let's break that down little by little. So let's start with why these may be securities, and there's four pieces of this Howey test. I mean, should we start there and kind of look at that? Are these token securities? Will the SEC maybe crack down on them as securities?
Well, I can tell you they've hired. So taking a step back, at my firm where I worked until 11 months ago, we had 16 of our partners had worked at the SEC.
Okay.
We were constantly engaged to help people assess their risk, that what they were doing was issuance of an unregistered security. And many of them, once they got our advice, many of them moved offshore to places like Estonia
and Bahamas,
Isle of Man, places I've not yet visited, to do their token offering, and then they had to avoid issuance to U.S. residents. So the Howey test, to me, is a artifact, and I disagree with Gary Gensler when he goes on every show and says, I don't know why people are clamoring for new rules or clarity of rules. Nothing could be more clear. There's a case at the Supreme Court in 1946 that deals with orange groves in Florida that clearly explains what a native token on a decentralized platform, whether that's a security. To me, it's a non sequitur. It's ridiculous. It is square peg and round hole. And so now we have briefs. I filed these briefs where you try to apply the orange grove test to something that was unheard of, certainly, in 1946. And I think that clearly the last two chairmen of the SEC has said basically everything they've seen is a security except Bitcoin and maybe except Ethereum. And so whatever the law is, that's a pretty interesting data point if you are in the business of minting tokens that the SEC has said those are securities. So one thing people miss, they see these SEC enforcement cases against issuers of these tokens. What they miss is it is a crime in all 50 states to sell an unregistered security, which is what the SEC is saying these things are. People have gone to jail for selling unregistered securities. So the risk is quite significant. And so you have many, many projects. It's astounding, really. If you go on CoinMarketCap, Mark, you know this, there's
22,000.
22,000. I was about to say 21. There's 22,000 tokens. And the vast majority of them have the indicia of securities. But you know, in fairness, what I would say is the Howey test is not a good test for whether these are securities, and the reason is that you do not gain an equity interest in the underlying operation. You don't have a right to any of the profits generated by, if Yuga Labs does a project that has a token associated with it, you don't own a fraction of Yuga Labs. And the VCs, to your point, the VCs have, on occasion, bought these tokens with the thought that, you know, they'll rapidly appreciate due to some factor, either the success of the underlying operation or, you know, the rising tide of the alleged 4-year cycle. But really, the VCs are buying actual equity of the underlying companies not just tokens, where they have stock in these private companies. And when people talk about this or that is a unicorn worth $1 billion, well, Andreessen Horowitz was probably an early seed investor in the stock of that company, and therefore, should it get bought or go public on a stock exchange, Andreessen Horowitz will reap, what VCs look for, 100x return, 1,000x return, something like that. So this is a big topic. There are many conferences that deal only with this topic. A lot of token buyers think they're actually buying some interest in the underlying business operation, and they're certainly not doing that.
Well, I would certainly agree that a 100-year-old law about orange groves can't possibly work for something in the digital age. And so, and let me just set the record straight. I talked about in my video and on my Twitter thread. I am not for regulations. I think we should be free to do what we want with our money, and I don't need the government to protect myself. I should be able to protect myself. So I just do want to say that as well. However, the law is what the law is. And so I want to dig into a couple points on this Howey test and ask you about them. But when I read the 4 points, and I know these 4 points are broken down by another 98 points or something like that. But when I read just the 4 points, it says an investment of money. So I'm giving someone money. 2, in a common enterprise. So some sort of people are running this kind of a thing. But 3, an expectation of profit. So it doesn't say anything in there and that I should have ownership. That's not listed in this at all. But it's, did people buy it thinking they would get a profit? And I guess, now that's subjective. You have to go back and ask every single person in the world, why did you buy this? But I think if you just Google, and I did this, if you just Google crypto or altcoin, like it all is about investment. Like that's the number one keyword that matches up with that. And so they all bought it. I mean, people bought FTT token because they can get a discount of trading fees on FTT. It's not why they bought the token. They thought that token would go up in value, right? Like I get a discount at the grocery store when I type in my phone number, but I didn't buy anything to get that because I don't think it's going to go up in value. They just give me a discount. So anyway, I think it was with that expectation of profit. And so I guess the question is, did people give up money, and were they hoping to a group of people, and were they hoping for it to go up in profit? And I would guess the answer would be yes.
Well, Mark, your take, I don't know if you sound a little bit like a lawyer, but your take has prevailed almost everywhere. So you're on the winning side of this argument, and Gary Gensler's argument that this old test is the one we're going to use, and under that test, all of these tokens fail.
So if hypothetically, so I'm, hey, all these people that got all mad at me, they say, "Oh, Mark, you don't understand. Like they can't stop the progress." So yeah, so if I started a project and I created a token, I didn't raise any money, or I had some early, friends and family rounds or some VC rounds, right? And we created the software, and then I decided to launch this token that was available. And then maybe on a third-party market, those tokens became valuable and there was some resale going on, but I wasn't actually selling those to people. And that would be totally different. I think it's the very act of me trying to raise money for my common enterprise, selling something is what kind of makes it that security.
Yes, that's a telltale sign of a security, and it's in the list of factors that have dribbled out from the SEC over the last 10 to 12 years. The way I look at it is everybody tries to apply the Howey facts and test to their circumstances of a token issue. And I would argue what we ought to do is the reverse. Let's look at the situation of this token and see what it would mean to the orange groves. Here's what I mean by that. What if the investors in those orange groves did not acquire any acreage of the orange groves, just as token buyers acquire no property other than this ephemeral token? It doesn't represent stock. It doesn't represent a claim on profits. Let's say we took the facts of a token and put it into that 1946 case. All right. So the investors in that case now have no property. They own no orange groves. Secondly, let's take the 99.99% of tokens where there is no income stream. There are a few out there that operate a little bit like a bond, but let's forget those and look at the 99%. Those 99% also have no claim on the profits of the underlying business. So there is a business that runs this program called the Graph, and there are Graph tokens. And when you buy those Graph tokens, you don't own any of the underlying business, and you have no right to their profits. So let's apply that to the orange groves now. Not only do the investors have no property in Florida, they also have no right to split up the interests of the harvest each year. They don't get their percentage of the orange harvest. If that was the case, Mark, in 1946, of that situation with the orange groves, with those two factors, it's not that the government would lose that case. The government would never bring that case. That never would have been brought. If the investors own nothing and have no rights to any harvest, there is no case. And so I'm arguing in the wind a little bit on this score, and I will probably submit amicus briefs when the time comes, perhaps even in the Ripple case. But I believe people are looking at it wrong, and that you should take the facts from the token world and apply them back to that 1946 case. And the result is that case would never have been brought because it would have no possibility of prevailing in court. Mm-hmm. So there is an argument on the other side. Your side has been winning and winning quite consistently.
I don't want to say my side because, like I said, I don't think we should even have. I think we should just disband the SEC. That would be my guess. They're supposed to protect consumers, but look how good of a job they're doing. What I would say though is, and again, I would ask. I believe that you have like court law or precedents, like this Howie is, right? But the more times it's used, then the stronger it gets. And it also starts to morph and evolve over time how it's being applied to other things. I'm obviously not an attorney. Don't listen to anything I'm saying, and I'm just reading something off of Investopedia here. But it doesn't say anything about applying it to an orange grove. I know it started from that case. It doesn't say anything about they owned it or whatever. It just says an investment of money with an expectation of profit in a common enterprise. So I would just go back to say, well, am I giving it? Why did these people give up money? They thought they were getting something back in return. But let's get past.
How about this, Mark? What if you go to a casino in Las Vegas and buy tokens?
Chips.
And you're hoping that you can gamble those tokens and make more tokens and then go back and cash it in for money. Those aren't securities because you don't own part of the casino. You don't have an interest in whether that enterprise is successful.
A better example would be like Chuck E. Cheese, right? So I go to Chuck E. Cheese, I buy tokens, and I don't have any control or interest in Chuck E. Cheese. So maybe that's a good example.
That's an example. Yeah.
Yeah.
But those utility tokens, you've heard of those. I think of airline mileage points, that you receive these, but you don't own any part of the airline, and you can use them for stuff.
To me, the difference would be, and again, I'm no attorney, and I don't really want to be taking the SEC side of this, but for plain devil's advocate, the way that I would look at it is if I'm going to Chuck E. Cheese and I'm buying tokens to play video games, I'm buying the tokens, I'm playing the video games, and then I'm done. But Chuck E. Cheese didn't do a IPO selling tokens to raise money to go build all the Chuck E. Cheeses that you hope one day if they do a good job, they'll build the Chuck E. Cheeses, and at some point I could then go use them. So does it have something to do with like the proceed of funds kind of a thing? Like where like...
It's a factor that the SEC definitely uses, and I would simply endorse what you said at the beginning. There's really nothing unusual about an old precedent kind of growing over time to accommodate new things. When you say that, you are, of course, describing the United States Constitution. So there was no air travel in 1780s and all these things. It had to adapt to new technology. But yes, I'm a little bit of a voice out in the wilderness here saying let's reconsider whether it's really a good match for the Howey test.
So now let's see how good your crystal ball is, and let's see, like, where do you think this goes? So you had made the case that you think that, now is one. I had made another video where, like, maybe this was a little bit intentional, where he was taking all this money. He was then working with regulators to impose all these new regulations, trying to almost kind of corner the market. Now, even with them being bust, it brings even more maybe potential firepower or attention that they could bring and try to push through all these regulations. So I guess the question I'd ask is, like, where does this go? Do you think that, to the point you said, that maybe this gives them some public attention, they can now push through a lot of regulations? Do you think they'll start cracking down? Or do you think, no, they probably are not cracking down because they know they don't have a good case, and maybe nothing really will actually come of this?
Well, I think a lot is going to come of it. And I put out a list of top 10 winners and top 10 losers as a consequence of the FTX implosion. And the number one winner was Gary Gensler. So Gary Gensler has been getting some bad publicity because of this Ripple case, which he inherited from his predecessor. Jay Clayton is the one who authorized that lawsuit very shortly before he left office. So he knew he was going to have nothing to do with it. The problem with that case is the public perception. The problem is there are a class of XRP holders who have intervened in the case. These are the ones who are supposedly injured, the ones that the SEC is supposed to be protecting. They've entered the case together in a class action to ask the SEC to stop what they're doing and stop destroying Ripple, because they believe in it. They own the token. They knew what they were doing when they got the token. And this is a big waste of time. We are not victims here. We're good. We want you out of here. That is an uncomfortable spot.
You mean don't ruin our investment? We're hoping to get some money back out. Don't crush it to zero.
That is precisely it, Mark. As you think about, I know you're an investor, as you think about risk, categories of risk and counting them out, the biggest risk associated with Ripple is the government itself. It's not fraud or misconduct or the market reception to XRP or anything. It's the government is the risk factor. That's not how it's supposed to be. And what's weird, and this sort of gets to your question, what's weird is everybody in crypto, you know this, I know this, everybody knows it. Of the 22,000 tokens, some of them are out and out frauds where the people just issued a token, took the money and split.
I would put XRP almost up at the top of that, though.
What's that?
I would put XRP up there. EOS may be the biggest, $4 billion they took and disappeared. But XRP, I mean, they create 100% of the tokens in a pre-mine, and they just enrich themselves, and they spend it all on public policy and mostly a lot of what I would consider fraud in the sense of promising things, promoting things that just aren't true. Look,
they have created utility situations. Banks have settled international remittances using Ripple. So there's something there. I'm just saying, why don't you get the actual fraud people who had no intention of building something?
The gross ones, yeah. What about this case with Library, where obviously the Ripple is sometime next year, we'll find out, but Library just got settled. Library created utility. They actually have a working product that actually people use. My videos go on Library or on Odyssey now. I don't know if anybody used XRP, but they used Library, and they claimed that they have utility, and the judge said there's no triable defense for that being I think that's the wording that he used. No triable defense for that. Like, it's a security, black and white. What does that have an effect on potentially with Ripple and other things?
Well, that had a ripple effect. So yeah, all the lawyers in the business were passing around that decision when it came out. And you know what? You'll hear people say, look, it's one judge's decision. What matters, what constitutes a precedent is a decision of an appellate court. And so we have all these courts of appeal throughout the United States, and then the Supreme Court sits on top of that. And there are, a lot of judges who get things wrong, mostly get things right. And so people will disregard a single judge's opinion, and what matters are what appellate courts say. And so I got this question on Twitter yesterday about what do you think is going to happen on Ripple? And I said, what I think is going to happen is everybody's going to overreact, whether it's a win or a loss, because what this judge has to say about it is really not going to be that important.
Interesting.
There are two more layers of appeals, what an appellate court says about this and eventually the Supreme Court. That's what will matter. But people will overreact. And what is that overreaction going to look like? You could see a lot of other tokens get delisted in a hurry. Then the liquidity fall out of bed. And therefore, if you can't sell a token easily, the value is going to plummet. So there would be, I would expect, significant market fallout if it's a full-on win for the SEC at the trial level.
When you said it was a win for Gary Gensler, or you thought he would be the biggest winner from this, you said, is he the biggest winner because he inherited this horrible case, but now it gives him some leverage on that? Is that why you were saying he might be the biggest winner?
No, I was saying it because there were people pushing back, politically on regulation of the space
Gotcha.
Pushing back on his enforcement efforts because he picked one with a bunch of people who do not view themselves as victims. But I'm getting, direct messages from people who are extremely distraught that they've been wiped out as a consequence of the FTX implosion. So having 1 million, victims and a lot of bad stories clears away a lot of opposition in Congress and in the media of who's the good guy, who's the bad guy here. There's a lot of, hey, I told you so. I told you if they didn't come in and register with the SEC, this sort of thing could happen. And now it's happened. And now we need two things. We need draconian legislation to regulate the heck out of this thing. And I'm going to use my, much, much larger enforcement staff to bring a bunch more cases. And my fear is that they're going to decide to go after domestic exchanges on the ground, crypto exchanges, on the grounds that they are trading unregistered securities. It is just as illegal to facilitate a trade of an unregistered security as it is for you or me to sell an unregistered security that we own and sell it to somebody else. That's illegal. Arranging for that to happen is also illegal. And so I will not be shocked. And Gensler will be able to say, look at 100 quotes in the New York Times over the last 2 years, in the Wall Street Journal, where I have said, hey, exchanges, you're trading unregistered securities. You need to come in and register with the SEC. And they have not done that. And so one could wake up one day and there be a court order that fill in the blank exchange must cease and desist trading in one or many tokens that the SEC is very confident they would win in establishing that it's a security under the Howey test.
So he doesn't need to go file lawsuits against 20,000 cryptocurrencies. He could just go after the 3 or 4 biggest exchanges in the U.S. and he could just kind of take it right there.
Right, and I think aren't you one of the self-custody, keep no keys, no coins guy?
I am, yeah.
Yeah, well, you've had a big I told you so over the last few days.
So to kind of, again, try to clear up your crystal ball a little bit, like how do you think this plays out? Do you think that, maybe we kind of wait and see, he builds up some strength and then we'll see what happens with Ripple, I think, Q2 of next year? Or do you think maybe the more likely chance is that he might just go after a couple exchanges and kind of do something there? Or do you think just government bureaucracy gets in the way and we go another couple of years and nothing really happens?
I think he would really, really like to have a positive ruling in Ripple that he could use all around the country. I do know they have many, many cases in the hopper that they have investigated that are pretty close to ready to go, ready to file in court. I don't know, don't have a crystal ball about whether he's going to wait. I doubt it that he's going to wait. You know, the iron's kind of hot now. People are angry. He's got Elizabeth Warren and this congressman, I don't know if you know him, Brad Sherman.
Of course I do, from California. Sure.
Yeah, so they're just, you know, absolutely thrilled by this FTX collapse and are demanding action immediately. And so whether that can meander through Congress or not, yet to be determined, but I think you are going to see significant enforcement actions in 2023. And I hate to say it really, but because it will be really bad to the whole ecosystem, but I could see a case against an exchange coming in 2023.
Now, yeah, just to clarify something you said. So Sherman and Elizabeth Warren trying to push new laws or new regulations through Congress because laws have to be set through Congress. The SEC just would enforce laws, right? So they're an enforcement agency. So they would enforce laws that are already there. So they don't need to go pass new laws to just go enforce what they think they already have.
Correct.
So those are two different things. Okay, got it.
Correct. So yeah, I mean, you could see laws that say all digital assets are securities, you know, then we don't have to bother with the Howey test and everybody's dead, you know, everything's dead.
Yeah. And just for the crypto bros, they're like, no, they can't stop. This is progress. Well, it doesn't mean that these companies can't exist. It just means they have to just file as securities, which people do every single day, right? No, not that easy?
It's not easy at all.
I mean, it's expensive, and as I made the case in my video, it's expensive, and there's lots of disclosures, and there's all types of things that you have to do. So it's not that easy, and it's prohibitive.
Yes. Yeah, it's complicated. So it is expensive, for sure. But once you are a registered issuer of securities, like any company trading on the NASDAQ or New York Stock Exchange or whatever, it's a whole new ball game in terms of how you run that company. You become subject to controls requirements in Sarbanes-Oxley that mean you're going to have to double your headcount immediately in order to generate the data and test the data rigorously in order for it to percolate up to accounting so that people can sign off on quarterly financials that must be reported to the SEC and to the public every quarter in 10 Qs. And then, you know, the compensation of the top 5 executives in the organization needs to be approved every year by the shareholders. It's a radically different looking proposition once you are a public entity and your securities are listed with the SEC or registered with the SEC.
Yeah. So it definitely slows things down, to say the least. Right?
Well, you know, on the bright side, I guess, you know, instead of 22,000 projects, there might be 50 or something that are really, you know, valuable and good projects, or maybe less, I don't know, where it is an income and perhaps profit generating enterprise, then they could do it, and, you know, the rest would simply fall apart. But if they have useful technology or intellectual property, it would be acquired by the survivors. And that's why I look at this as a little bit of a deja vu potential to the 1990s, when there were all these young kids who quit what they were doing at Harvard and MIT and Stanford and all congregated in one spot called Silicon Valley to build businesses on an emerging technology called the internet. And so now we have the same thing. We have an emerging technology called blockchain technology, and people like Vitalik and all the rest of them are dropping out of school or dropping whatever else they were doing to work on projects. Well, in the 1990s, most of them failed, but some of them succeeded spectacularly. And if I were to have a crystal ball, that's my guess as to what this crystal ball would tell me, that we're going to find some really innovative, durable survivors from this shakeout that is caused both by market conditions, the crypto winter, VCs pulling out, and the government cracking down. That's quite a trifecta, right? So you should see a lot of projects go away and the strong survive, hopefully, if we're still in a capitalistic system.
I agree with that. You can't stop progress. I'm super bullish on humanity and entrepreneurs. The one thing I would just say, and it's a good parallel that you draw, is all those people went to Silicon Valley and they started all these companies and they raised money through friends and family and through early VC rounds. And there's nothing stopping from people building on blockchain technology and raising money through friends and family and VC rounds. It's the selling of the token that seems to be the sticking point. So no reason why you can't still go build on the technology. No reason why you can't still raise money from your friends and family and from venture capitalists, et cetera. That's how it's done in the internet days. That's how Uber got started. That's how Instagram got started. And so you can certainly do that. Of course, me being in the Bitcoin camp is I don't believe everything needs a token. So that's a whole different conversation. I think we went pretty long here, James. A lot of really good information. I appreciate you taking the time and giving me your professional and expert opinion on this stuff. I know you're on Twitter, just kind of getting started. You said you just kind of created your account, so everyone go give them a follow at Meta Lawman, META, Meta Lawman. Anything else you want to shout out, James, or anything else we forgot?
No, this has been a lot of fun, Mark. Would love to come back and talk with you. You really know your stuff. All I would say is Sam Bankman-Fried's interview is supposed to be coming up at 5 o'clock Eastern, so everybody tune in for that. It's supposed to be live streamed by the New York Times, and it'll be interesting to see if Andrew Ross Sorkin asks any of the questions that I sent to him. They were tough ones, and it should be interesting.
Yeah. All right, James. Thanks so much. I appreciate it.
Thank you.
All right, that's a wrap. Hopefully you enjoyed this interview with James Murphy. You got to go directly to the source. You got to go talk to experts, people who are in the trenches, who have information. Hopefully that was helpful for you. If you liked the video, give me a thumbs up on this video. Get the algorithm boost. Let's get him some follows. Of course, leave me a comment. Let me know what you think. Hit that subscribe button. And then before you leave, I'd advise maybe you want to go back and watch this video I did talking about why cryptos won't see another bull run for the full reasoning behind it.